Stocks meander. No progress today on the rebound after last week's encouragement from the Federal Reserve. And we're going to take our focus here away from equities until they decide what it is that they think they're doing and focus on the other big market that's on the move around these on again, off again recession fears that have been pummeling the markets since the end of February, and look at currencies, because one of the things that has been a standby of all of this consternation has been a sinking U.S. dollar. I'm going to take a look at what that means, why it has happened this way, and see if we can't figure out if, as stocks rebound, the dollar is also due for a comeback. What that might mean and what the trade could look like if it is or it isn't. So, let's begin here with a conversation first and foremost about how we arrived at this interesting juncture. So we have here U.S. inflation expectations and monetary policy expectations, as well as their reflection in asset prices. At the top, you have U.S. break-even inflation, the 5-year and the 10-year rate, very interestingly here, first, what you see is that they've both been declining recently. And you notice that this has been going on at the same time that you've had a pullback in both front and long end yields. So down here, you have the 10-year, you have the 2-year, yields lower there. And of course, as this is occurring, you're also seeing that the U.S. dollar, this is the dollar index here in the green, it's been pulling back at the same time. And of course, this is the same exact story that has given us the stock sell-off, the 4 weeks of blistering selling in equity markets since about the middle of February into the middle of March. We finally stalled on that sell-off and broke the 4-week trajectory there last week, but only by a hair. We ultimately ended up stalling, and now this week we're trying to maybe turn that stall into some kind of a rebound. But the story here falls over exactly the same time frame and is occurring for the same reasons. And that, of course, is what we have summarized here with the Atlanta Fed's GDP Now model. Now, it's probably not realistic that in the first quarter of this year, the U.S. economy is going to contract at an annualized rate of 2%. That's probably too extreme. In fact, the PMI numbers that we just saw out of S&P Global guesstimate that instead we're going to get a slowdown to something on the order of 1.5%. So somewhere nearby this range of major forecasts from big financial institutions. But the key insight in this Atlanta Fed GDP Now model isn't so much its level. There's still quite a long time for it to even out until the first quarter GDP numbers are actually due to come out. There's a lot more inputs into this data. Instead, what this tells us is the tone of the inputs that have been coming into this model since February. And what we find is very clearly the tone has been very negative. So what this model does is it takes incoming economic information and spits out what it thinks the Q1 GDP number would be if no more data came in on any given update. And this is the data here as of the latest update. That update was made on March the 18th. So we're talking about a week ago is the latest. We're going to get the next update that's coming up to this tomorrow. It'll probably edge up a little bit more and reflect the tone of the data getting a little bit less awful just in the past week. But Nevertheless, you very clearly get a sense that U.S. economic news flow would have had to be relatively awful for the better part of a month, going from about here to about here, in order to produce a model that gives you this level of a drop-off. And so really this is more a lens on just where the market's recession fears are coming from. As incremental pieces of data come out, this is what the model exhibits. And what that tells you is the data itself has been terrible. And that, not surprisingly, gives you weaker stocks. And of course, less inflationary pressure. Of course, more expectation for Fed stimulus and so lower yields. And with that, a loss of the dollar's yield advantage to some marginal extent that then moved the dollar lower relative to other currencies. Now, we saw last week, and this is sort of what put the floor under stocks here near term, is the Fed came out and gave us their updated summary of economic projections, and they did dutifully revise growth expectations lower, lower for this year, lower for next year. But they kept the path of interest rates unchanged, essentially saying we don't know how sticky of a growth scare this is. We don't know to what extent it's warranted yet. So we're going to wait to see more hard, quote unquote, data to get a clearer read. So the Fed seemingly at once commiserated with markets about these concerns, responded by showing that they're paying attention, that they're prepared to act if necessary, but that they don't see urgency to pull the trigger. And as if on cue, at the start of this week, we saw U.S. manufacturing and composite and service sector PMIs updated, and they came in better than expected. In particular, the service sector numbers that were the source of such consternation in January and February, because, of course, you can plainly see here with the naked eye, the composite index is tracking the service line, and the manufacturing line is kind of on its own, which tells you just how important services are for the overall economy. The economy is driven primarily by services. So when services saw this massive decline here, and the composite index went with it, that's really what spooked markets and started to get them thinking about, whoa, maybe we're looking at a recession. In these March numbers, there's been a rebound, and it's not the kind of rebound that puts recession fears to bed. Certainly, there's been a level shift from growth up here to growth over here. But these numbers came in overall better, all three of them, than the markets thought. Faster service sector growth, as ever, these numbers are centered around 50, where that's neutral. Under 50 is contraction, above 50 is growth, and the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So faster growth for services, faster growth for the overall economic activity, and weaker performance than expected from manufacturing. In fact, it's now narrowly in contraction mode again. But as we said, services is the much more important piece here for the overall story. In fact, all of the U.S. outperformance last year happened with very anemic conditions in manufacturing. So that seemingly has convinced the markets that the Fed was right, that there is no emergency, that at least for now it's okay to wait and see. And so the markets moved, obviously, through this recession scare. They adjusted policy expectations to something more dovish. This was the beginning of the year where maybe we were looking at something like 50 basis points in rate cuts. And this is where we are now, basically in line with the Fed's expectation of about 4. Indeed, the markets are a little bit more urgent. They have a bias to erring on 3 cuts this year and 1 erring on 2 next year, whereas the Fed is, of course, at exactly 50-50. So 50 basis points from 4.4 to 3.9 this year, from 3.9 to 3.4, another 50 basis points for next year. But when you look at this in broad terms and you sort of allow for market volatility and speculative fuzz, you are basically looking at alignment. And so the question then becomes, well, what is the impetus for speculation then on a still weaker dollar? Are we perhaps done with making the adjustment, at least for now, that has given us this dollar sell-off? And is this maybe the time to look to bottom fish a bit? Now, if we look at the way that the dollar has performed since the beginning of the year against the major currencies, we can see the euro and the yen have done the best. In fact, the euro at one point was the clear outperformer. It was up almost 7% since the beginning of the year as of last week. And that's, of course, around speculation that there's going to be a ton more European defense spending to make up for what is now looked at as a less reliable American security umbrella. We've, of course, seen that become something that has really taken on a lot of urgency in Europe. Germany has suspended its debt brake for defense spending even before the new chancellor, Friedrich Merz, takes office and the new Bundestag sits. And that's largely because the new Bundestag probably has some veto votes from hard right and left minority parties. And so there was an urgency to get this done before the new government is even installed. And so the ruling coalition of the SPD and CDU-CSU, center-right, center-left, managed to cajole the Green Party into getting this done so that this defense build-out can happen faster. That, of course, speaks to a lot more spending in Europe, probably a lot more inflation. The bonds have certainly cratered and yields have gone up. And not surprisingly, that at a time when U.S. yields have come down, as we've just seen, has shifted the balance for the euro significantly. And, of course, that has powered its outperformance. Lagging behind the bunch has been the Australian dollar. It's much more anchored to global growth than the rest of these top 4 currencies. And, of course, we chose these 4 because these are the top 4 counterparts by turnover for the dollar, according to the latest numbers from the Bank of International Settlements. These 4 overwhelmingly account for almost all dollar-based volume. Everything else is relatively small. And so as you look at all of this, then you get a sense that for a currency like the Australian dollar, the risk-off tone has really weighed, and it's increased against the dollar, but not by a whole lot, less than 2%. It was up as much as 3%, but has since come in, and of course that has not compared favorably with the rest. The yen has done exceedingly well, as it tends to do when U.S. yields fall. And the British pound has interestingly lagged. And this is perhaps where the opportunity arises. So we know that Europe is looking at this defense build-out. We also know that the UK is very much a part of this conversation. In fact, there is increasingly a discussion about how France and the UK together might form a peacekeeping mission in Ukraine, about how they might become together the new nuclear deterrent in Europe to essentially have a common second option for the region that isn't the U.S. And with that, you also have a big fiscal spending story. Moreover, if you look at what has happened now with policy expectations by year end, we can see that with this dovish adjustment in U.S. expectations, that's the blue line here, and what these numbers here reflect is year-end interest rates that are priced into the relevant futures markets, Fed funds futures for the U.S., ESTR for Europe, SONIA for the UK, so on, the bank bill futures in Australia. If you look at where we are now, Japan, of course, has the lowest interest rates of the bunch. That's to be expected. The European Central Bank is next, and you can see their expectations have been drifting higher around this build-out idea. The key thing here in the relationship between the US and the UK, though, now looks like the dovish adjustment in the US puts the year-end rate below that of the UK. The UK is now expected to have the highest interest rates of the bunch here by year end. And that makes this underperformance eye-catching, suggesting that maybe there's room for the pound to have an outsized move higher against the dollar that it hasn't played out yet. And we have a catalyst here just on the menu in the coming hours by way of UK CPI data. Now, the expectation is we're going to get a little bit more disinflation, but not dramatically so. Down to 2.9% year on year for the headline, down to 3.6% year on year for core. For core in particular, we can see we're still very much stuck in the range that these values have held since 2024, and we're not really going anywhere. In fact, if you look at the internals of the previous report, what you see is this very stubborn, sticky inflation in areas of the spectrum here that really you would think would be much more amenable to a decline in discretionary spending around slower economic activity in the UK until recently. And yet, you still have recreation and hospitality adding essentially a full percentage point to headline inflation. Cut those by half, and you would be much closer to the target. Cut them down to something more historically normal, and you might well be pretty much on the Bank of England target. But nevertheless, here we are, and the stickiness here seemingly resistant, even as, if we look at the latest UK PMIs, going all the way back to the middle of last year, the economy has been slowing across services and manufacturing until this latest upswing here in March. So ostensibly, you have a situation here where the slowdown in the economy should have shifted spending away from discretionary and toward more core spending as the economy creaks along and consumers become more defensive, but that has clearly not occurred, implying that maybe something is sticky here, perhaps because of inflexibility in the labor market. And with that, you have something of a bind on the BOE's hands to cut rates. If we look at the expectations currently, we're sitting at maybe 2 cuts for this year, but that has been diluted some, only 39 basis points out of 50 actually baked in here, which if you take a look at then the likelihood of that next cut, you're really only looking at a situation where you have just 14 basis points toward that second cut that's priced in. It's narrowly better than even odds that you get 2 cuts, 56%. But it has significantly diminished. And next year, you're looking at essentially standstill. So the story here is one of a Bank of England that is not in a hurry and where things have been relatively stable around the forecast for a while. Moreover, as we just saw in the PMIs, March marked something of a perking up of the service sector. And so even though you might have a little bit of a downswing here on inflation, the likelihood that this is going to move the Bank of England to move any faster seems low. In fact, we just had a policy announcement from them last week, and they were a little bit more hawkish than expected. The number of people voting for a rate cut on the MPC, the 9-member committee that decides a policy, that minority ended up being smaller than expected. It shrank to just one vote arguing for a cut at this point. And that's certainly not something that seems amenable to one small downtick on inflation that doesn't really take the trend in the right direction by itself. All of which is to say, we might have a situation here where what this CPI report does is reinforces the idea that the Bank of England is going to sit on its hands for a while. And if these dynamics here, this starting of normalization a little bit in the service sector, begins to show up as demand pull inflation, well, then maybe the numbers actually have scope to surprise on the upside. And in that case, this underperformance from the British pound relative to the dollar is going to start to look glaring. Now, the levels readily present themselves. We can see here we're consolidating just under this former support become resistance cluster where we've held so many times before in the 130 to about 130.50 area. Now, negative RSI divergence here suggests that as we came into this high, momentum was ebbing, and indeed we've stalled. But what we haven't done is lost grip on this support above the 128 area. If the CPI number gets us through 130 and gets us somewhere over here, we then have, seemingly, an open lane north of 132, and then, of course, above that, an open lane north of 134, but that's the next consideration. But the up move here is holding, unlike perhaps what's going on in the yen, unlike perhaps the greater damage that the euro has sustained in the near term. Its pullback has been more sizable. So what we could have here is a coiling up before the next leg higher, and the UK CPI numbers may well give us that catalyst. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise coming back in just 30 minutes time for the Price of Truth with Victor Jones. Stick around for that. I'm also on with Chris for Futures Power Hour Mondays and Fridays, on with Victor and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.